Yes, so what are we told? That is question number 5B of last sitting. So the question is, Belta Limited purchased an equipment for shillings 12 million on 1st July 2021. Depreciation on the equipment is provided on a straight line basis at the rate of 25% per annum during the 4 years from 1st July 2021 to 30th of June 2025. A profit after tax and allowed wear and tear charges for the purpose of tax were as follows. So in that case, we are given basically 4 years. From 4 years there, we have the profit after tax, and then we have the allowable wear and tear wear and tear charges, allowable wear and tear charges, basically here. And then what we are required to do here, we are required to compute the taxable profit. We are also required to compute the temporary differences. We are also required to prepare an account which is called the deferred tax account. Now, this particular question, there is a typing error, and also the typing error was in this question. So the profit which are given below paragraph 1, that one should be the profit before tax. Because if you can be able to recall in our previous session, we said usually for you to be able to compute, for example, the taxable profit there, you must be given the accounting profit. The accounting profit is basically the taxable, the accounting profit, is the profit before tax. So whatever you're given there should be the profit before tax. So if you have the physical paper, can you change that? That one should be the profit before a tax, not after tax. Yes, because I say that this question has been repeated for 3 times. The first question, I think it was around in 2012. The question was okay. But if you check on this question, it was put as profit before tax. Here it was also put as profit before, after tax, that is. But it should be profit before what? Before tax. Now, what I want us to do, I want us to start with what is required in Roman 1. And basically, that is what? That is the taxable profit. That is the taxable profit. Basically, we are required to compute the taxable profit of this company for how many years? Basically, we are required to compute this for 4 years. Now, there is a small concept I need to explain here. Though I said these are concepts you'll be able to discuss in details. You're going to discuss in details in what? In taxation. Now, if, for example, you're required to compute this taxable profit of the company, and you're given the accounting profit, you are given the accounting profit. The accounting profit, remember in this case, we said the accounting profit is basically the profit before tax. So that's why I'm saying the profit which we have there should be the profit before a tax. So if you're given now this accounting profit or the profit before tax, how do we compute this one? To compute this one, so what we do, we add back, the disallowable expenses, disallowable expenses. So when talk about the disallowable expenses, basically, these are the expenses which were deducted in arriving at this particular profit here. But basically, those particular expenses should not be deducted from the total incomes of the company in computing the taxable profit as per the existing tax laws. So in this question here, we only have one disallowable expense, and that disallowable expense is basically depreciation. Now, we know that in arriving at this particular profit here, the accounting profit, all the expenses of the company have been deducted, including what? Depreciation. But basically, we say depreciation. This one is a disallowable expense. Whenever you're computing the taxable profit in your company, you should not let depreciation. Instead, you should compute something called the capital allowances or something called the investment allowances. So all these are details you'll be able to discuss in details in PFT, or basically what? Taxation. So what we do, we basically add back the disallowable expenses. In this case, I'm saying here we only have one, depreciation. So we are going to compute the depreciation, we add it back. And then to this, we less the allowable expenses, which were not deducted in arriving at this profit. What are allowable expenses? Allowable expenses, these are those particular expenses which should be deducted from the total incomes of the company as per the existing tax laws when computing the taxable profit. So now, once we have acquired an asset, we have said, as an accountant, what you do when preparing the financial statement, you compute depreciation. And naturally, that depreciation, you account for it as an expense. But you're saying depreciation is disallowable expense. This one should not be deducted from the total incomes of the company in arriving at the taxable profit. That's why we are adding it back here. And then number 2, once you have acquired some asset in your business and you have incurred some cost, the taxman allows you to compute something called the capital allowances or the investment allowances, and this one should be computed using rates which are provided by the Kenya Revenue Authority. It is the Kenya Revenue Authority which provide these rates that if you acquire a certain asset like a motor vehicle, like maybe a machine, a processing machine, that is how you should compute the capital allowance, or basically the investment allowance. But I've said all these are details. You'll be able to discuss in details in tax. So therefore, to this we less allowable expenses not deducted in arriving at this. And in our case, we have the wear and tear allowances. Wear and tear allowances, we less it here, and basically whatever we will get here, this one is called the taxable profit. If now you want to compute the actual tax to be paid by this company, you'll take this particular taxable profit, you multiply that with what? With the tax rate. So therefore, for us to be able to compute this is what we need to do. We take the accounting profit, we add back depreciation, we less what? The capital allowances. And actually, we need to compute this for 4 years. Basically, the first year ended 30th of June 2022, 30th of June 2023, 30th of June 2024, and 30th of June 2025 there. Then we are given our values here in thousand of shillings, in thousand of shillings, in thousand of shillings like that. So then from there, we basically compute the taxable profit using this particular format here. So we start with the accounting profit, profit. So this accounting profit, I've said, this should be the profit before tax. That's why I've said in this question, there was a small typing error. The profit which you're given here should be profit before tax, not after. Sasa, yes. So let's take those particular figures. We have an amount of 24. We have an amount of 27. We have an amount of 27. Then we have an amount of 2850. 2850. And then we have an amount of 2550. 2550. And then to this, what do we need to do? To this, we need to add back depreciation. We need to add back depreciation. We need to add back depreciation. Why are we adding back depreciation? Is because in arriving at this particular profit here, depreciation we know has already been deducted, but depreciation is not allowable expense. Depreciation is a disallowable expense. So in arriving at the taxable profit, depreciation should not be deducted. How do we compute the depreciation of this company? We're going to use the information we have in paragraph 1. In paragraph 1, we are told this company purchased an item of equipment at a cost of 12 million on 1st July 2021. That is now the start of the first year here. And then you're told that depreciation is provided on a straight line at the rate of 20% per annum. Recall, when computing the depreciation using straight line, we compute depreciation based on cost. So therefore, to compute this depreciation per annum, we will take the cost of the equipment as per the paragraph 1. The cost of equipment is 12 million, but basically we are going to take that as 12,000, and then we multiply that with the rate of depreciation. The rate of depreciation is 25%. So at the straight line, we compute the depreciation based on cost throughout. So meaning that the depreciation here will be uniform. So what do we get here? We have 0.25 multiply that with 12, and basically that will give us 3,000. It's also important for you to note that if, for example, we are depreciating an asset at the rate of 25%, for you to be able to know this depreciation will be provided for how many years, you can take 100% and basically you divide that with 25%. So this one will give us 4 years. So if you are depreciating an asset on straight line, you provide depreciation for the next 4 years. Sasa, yes. And that's why, for example, if you add this, it will give you 12,000. Sasa, yes. So then to this, after adding back the depreciation, we then proceed and we less the wear and tear. The wear and tear allowances. Wear and tear allowances. Now, this particular wear and tear allowances, for example, maybe those who are doing PFT, we also refer to them as, generally, we can also refer to them as capital allowances. We can also refer to them as investment allowances. I'll say that these are allowances which are computed, or these are basically allowable expenses which are computed as per the rates or using the rates which are issued by Kenya Revenue Authority. So how do we compute this particular wear and tear allowances? We are going to use the rates which are basically given below paragraph 2. Below paragraph 1, basically we have allowable wear and tear charges for tax purpose. In the first year, remember, these wear and tear allowances, these ones are provided on the cost of the asset, the cost of this asset. Yes, so the first year is 40%. 40% of this will basically be 4,800. This one, remember, is to be deducted. Year 2 is basically 30% of this, which is 36. And then year 3 is 20% of this, which is basically 24. And basically year 4, that was year 3, year 4 will be 10%. 10% of this basically will be 1,200. Will be 12 what? 1,200. So those are basically the way in here allowances. And then what we need to do is basically we proceed and we compute the taxable profit. We compute the taxable profit of this company. So how much will be the taxable profit for the first year? So for the first year, we have 2,400 plus 3,000 minus the 48. And basically, I'm getting 600. Then the other year, we have 27 plus 3,000 minus 36. And basically, I'm getting here what? I'm getting 21. Make sure you confirm those values. Make sure you confirm those values, whether those values are correct. Make sure you confirm whether those values are correct. You confirm whether those values are correct. Yes, then year 3, we have 2,850 plus 3,000 minus 24. And basically, this one will give us 3,450. And then finally, we have 2,550 plus 3,000 minus 1,200. And basically, I'm getting 43 what? 4350. Yes. So that is basically the taxable profit. Now there are some instances, although that one is not required in our question, there are some instances whereby you may be required by the examiner. You compute the current tax. You compute what? The current tax. Remember, in this case, we said the current tax. This is the actual tax to be paid by the company, and this one is computed based on the taxable profit. So to compute this one, we take the taxable profit. This one we can just abbreviate it as TP, taxable profit, and then we multiply that with the tax rate. We multiply that with the tax rate. So are we given the tax rate in this particular question here? Are we given the tax rate? Are we given the tax rate? Yes, we have the tax rate in the just above the requirement. The tax rate is 30%. So if you're required to compute the current tax, basically that one would be 30% of this. 30%, 180. 30% would be 63. And basically 30% of 3450. That one would be equal to 1035. And then 10% of this, sorry, 30%. 30% of 4350. That one will be 1305. So in case the examiner requires you to compute the current tax, that is basically how you compute that. That's how you compute that. Let's move to the other part of the question. The other part of the question, and basically Roman 2. Roman 2, we are required to compute what? Roman 2, we are required to compute the temporary difference. The temporary difference, and that is TD. Recall, in our previous class, we say that this temporary difference, it is basically the difference between two values. It is the difference between the carrying amount and tax base. So this one, TD, that is temporary difference. This one is equal to carrying amount minus the tax base. Minus what? The tax base. Carrying amount minus tax base. Then you have to recall, we said carrying amount, this is the value at which an asset is recorded in the statement of financial position. A tax base is the value of an asset for tax purpose. Is the value of an asset for tax purpose. And therefore, from the information which we have here about this, because here we have only one asset, so what will be the carrying amount? The carrying amount, this one will be equal to the net book value. Because if, for example, you're required to record this equipment in the balance sheet, in the statement of financial position, you record it at the net book value, which is equal to the cost minus accumulated depreciation. So therefore, carrying amount is equal to the net book value, which is equal to the cost minus accumulated depreciation. That is what is important for you to know there. Carrying amount of this equipment will be equal to the net book value, and that is equal to the cost minus accumulated depreciation. What about the tax base? Tax base. Now, tax base in this case is something called the written down value. In taxation, we don't talk of the net book value of an asset. We talk of the written down value. Once we have taken the cost of an asset, we have deducted these wear and tear allowances. You get something called the written down value. So to compute this one, we take the cost of the asset minus the wear and tear allowances. Minus the wear and tear allowances. Wear and tear allowances, these ones. Yes. So therefore, what we need to do, we need to compute the temporary difference basically for the 4 years. And for us to be able to do that, we will compute the net book, the carrying amount, which is equal to the net book value for the 4 years. We compute the tax base, which is equal to the written down value. So what we need to do here is we have our 4 years, whatever you have here, that year of June 2022, that year of June 2023, that year of June 2024, that year of June 2025. Then the next item you need to have here is the carrying amount. You can write that in full. Carrying amount, CA. And remember, our values here are in thousands of shillings. Then we will have TB, tax base. Also write that in full. The difference between these two values will be the temporary difference, the TD, the temporary difference, the temporary difference, the temporary difference, the temporary difference. So basically what I've said, having this knowledge now that carrying amount is the net book value, and then tax base is the written down value, then that one becomes quite what? Simple. So we can just compute that directly. So in the first year, we start by computing these net book values, which is equal to the cost minus accumulated depreciation. So the net book value for this equipment at the start of at the end of the first year will be equal to the cost, which is that one, minus depreciation for year one. Minus the depreciation for the first year, only 12,000 minus this. And basically that one will give us 9,000. In year two, we will take the cost minus depreciation for year one and also depreciation for year two. Because at the end of year two, the accumulated depreciation is 6,000. So 12,000 minus 6,000, that will give us 6,000. Then at the end of year three, we take the cost minus depreciation for year one, for year two, for year three. And basically that one will give us 3,000. At the end of year four, we take this minus that, minus that, minus that, minus that. And basically the net book value here will be 0. The asset will be fully depreciated. Yes. So then we compute the tax base, which you're saying is the written down value, and is equal to the cost minus the wear and tear charges. So the same. So we will take the cost, but here we less this one. We less that are wear and tear charges. So 12,000 minus 48, and basically that one will give us 72. So then for year two, we will take the cost minus this, minus that. So in this case, I'll get 36. In year three, I'll take the cost minus this, minus that, minus that. And basically we will get what? 12. And then at the end of year four, I will take the cost minus that, minus that, minus that, minus that. And automatically that one will give us what? Will give us 0. Will give us what? 0. So in our case, we already have the carrying amount. We have the tax base. Having that, then what do we need to do? We need then to compute the temporary difference. To compute this one, we take the carrying amount minus tax base. So this minus that, and basically that one is the 1,800. Remember, we say that this temporary difference can either be taxable or can be deductible temporary difference. We said we have two types of temporary difference. So what is important for you to know here is that if you get a positive figure, because this minus that is a positive figure, that one is called a taxable temporary difference, a positive figure. But if you get a negative figure, you have taken this minus that, you get a negative, it is a deductible temporary difference. Yes. So then this minus that will give us 24, which is still taxable temporary difference. This minus that will give us 18, which is taxable temporary difference. And this minus that, which will give us what? Which will give us 0. Which will give us what? Which will give us 0. Which will give us 0. Which will give us what? 0, 0. So basically, this is what is required here. That is what was required. Units, you just need to remember the formula. You just need to know the formula of computing the tax base. Tax base, we have said, is the written down value. It is equal to the cost minus wear and tear allowances. Just the way we have computed this one. So you have said to compute this tax base, you are taking the cost minus this. You see these are wear and tear charges, or wear and tear allowances. For the first year, you take this minus that. You get 72. For year 2, you take this minus that, you get 36. In year 3, and that is about carrying amount tax base, that is year 3, you take this minus that, minus that. Year 4, you take this minus this, minus that, which is basically giving us what? 0 units. I hope that is now clear. Yes, so this basically what was required, and the 2 marks were located there. And actually here, what was required is this. The marks which were located there were 2. Okay, so having that, then the last part of the question, we require to do what? To prepare the deferred tax account. To prepare the deferred tax what? Tax account. Now, even before you prepare this deferred tax account, remember what we said. We said on Tuesday. We say that in case a company has got a taxable temporary difference, we say that a taxable temporary difference gives rise to amount which are taxable in the future, to amount which will be taxable in the future. And therefore, we said if a company has got a taxable temporary difference, then such a company will compute something called a deferred tax liability. Remember those formulas which I gave you. The company need to compute something called the deferred tax liability. How do we compute this deferred tax liability? We take the taxable temporary differences which we have there, and basically we multiply that with what? We multiply that with the tax rate. We multiply that with what? With the tax rate. That's how we compute the deferred tax liability. Deferred tax liability, remember, these are taxes to be payable by the company there in the future. So what we are required here is we prepare the deferred tax account, deferred tax account. And I think even before we proceed to prepare this account, we can compute the deferred tax liability at the end of each year. So to compute this deferred tax liability at the end of each year, we are going to apply this formula which we have here. So to compute this deferred tax liability, we will take the taxable temporary differences, whatever you have here, and then we multiply that with the tax rate. Remember, tax rate is 30%. So the deferred tax liability at the end of year 1 is 0.3 times 1,800. So I've taken the taxable temporary difference, I've multiplied that with the tax rate. So that one will give us 540. The other year we take 30% times 2,400, which basically give us 720. Year 3, we have 30% of 1,800. And basically that will also give us what? That one will also give us 540, and I hope my computation there is correct. And then in the last year, we have what? We have 0. We have what? We have 0. Is that what you're getting? Is that what you're getting? Is that what you are getting? Is that what you're getting? Please confirm whether that is what you're getting. Please confirm whether that is what you're getting. Yes. Now, having this, what we need to do basically is we proceed and we prepare the deferred tax account. Now, this deferred tax account, we prepare it for each year. Remember, you have 4 years here. So mean that at the end of each year, we balance our account. And basically, whatever you have here, these are deferred tax liability. Now, this deferred tax liability is basically what we take to the balance sheet, to the statement of financial position. Yes. And therefore, at the end of this year, so you must be in a position to know where we record this amount of 540. So remember this account, we are preparing it for 2020. Now this particular amount here, that is 540. This one is a balance carried down because this is now what we take directly to the balance sheet. Take into account is a liability, is a deferred tax liability. Where do we record it? Do we record it as a balance carried down here? Do we record it as a balance carried down here? So if it is a liability, it's a deferred tax liability, you record it as a balance carried down here on the debit side. So the reason why we record it on the debit side is because generally what we know is that once we have balanced the account, we have to bring down this balance. So naturally, the balance brought down. This is something you need to recall from what you did in, I think, in financial accounting. So this balance brought, this being a balance carried down, brought down will be on the direct opposite side. So the brought down will be a credit balance because this one is a liability. So if you have computed a deferred tax liability, record the balance carried down here. And then what we do, we balance that account, assuming in this case, our account ended at that point. So we balance that account. You can see we will have a balancing figure on this side of how much? Of 540. Now, that balance which we have on that side cannot be carried down because we already have carried down. So the balancing figure which we have on this side, this one we take it to the income statement, and a balancing figure on this side, this one is called a deferred tax expense. I want you to write that in full. This one is called a deferred tax what? Expense. Write that in full. A deferred tax what? Expense. So this one, we take it to the income statement. It is called deferred tax expense. Deferred tax what? Expense. So, and basically now that should be the end of that account for that year. Sasa, but basically there is no way you can, or basically there is no need of preparing a deferred tax for 2022, 2023, 2024, 2025. So what we do, we just prepare this as a single account. As a single what? Account, but for different what? Years. Are we together? The single account, but for different what? Years. So, and that's why you have to double underline that. It basically means that we are done with 2022. So what we need to do in the year 2023, first of all, is to bring down the opening balance. So the opening balance, this one will be brought down on the direct opposite side, and is basically an amount of 540. That's how? Yes. So you need to understand what you're doing here because this is one of the item majority of the students don't understand. And this now, remember, will be the opening balance this year. So which will be 1st July of 2022. This is now the start of the second year. Then in that year, still we have a deferred tax liability of 720. We have said the deferred tax liability, we record it on this side. And remember that is the deferred tax liability at the end of the year. So that will be the balance carried down of what? Of 720. And then what we do, we balance our account. We balance our account. Now, when balancing our account, we basically consider what we have here. You see, what we have in the year 2023. So whatever you have in the year 2024, this one is ignored. In the year 2022, ignore that. We only consider what we have in the year 2023. This one should be 2023, this one. That's 2023. So we ignore what we had in the year 2022. So when balancing, we will add this, which is 720, and this. So you can see we have a balancing figure difference on this side of what? Of 180. 180. So this amount here will be taken to the income statement. And just like what I said up here, this one is called a deferred tax what? Expense. Is called a deferred tax what? Expense. So then from there, we move to the next year, which is basically the year 2024. So the first thing we need to do is we bring down this balance, this one. We bring it on the direct opposite side. On 1st July 2023, we have a balance brought down of 720. And then from there, in the year 2024, this one, what do we have? We have a balance carried down. We have a deferred tax liability of 540. So here we will say on that year of June 2024, we have a balance carried down of 540. And basically we balance our account. Equally, when balancing this account, we only consider what we have here. So what we have in the year 2024. So we have 540, 720. So the balancing figure will be on this side because you can see this side is more 720. We have a balancing figure here of 180. So this one equally will be taken to the income statement. I've said the balancing figure here will be taken to the income statement. And a balancing figure on this side, we refer to this as the deferred tax income. Make sure you write that in full. A balancing figure on this side is known as deferred tax income. Deferred tax income. Deferred tax what? Income. Deferred tax income. Deferred tax income. Then we move to the last year. So in the last year, I will start with the opening balance. This should be a continuation. This opening, this balance, we bring it down on the direct opposite side. So on 1st of July 2024, we have a balance brought down of how much? Of 540, 540, 540. Then at the end of that year, how much is the deferred tax liability? The deferred tax liability is basically zero. On that year of June 2025, the balance carried down is what? Is zero. So we balance our account. So this side is 540, this side is zero. So we will be having a balance figure on this side. And this one will be taken to the income statement. And I'll say that this one is called a deferred tax income. Is called a deferred tax what? Income. That one is called a deferred tax what? Income. Deferred tax income. Deferred tax what? Income. So equally that is what was required as far as this particular question is concerned. That is what was required. That is what was required. So what I want you to do, I want you to do this question. Though the two questions were just the same, although like this one they had given 8 marks, you can see this one they had given 6 what? 6 marks. But generally, that is what was required. This question has been repeated 3 times. 3 times. Actually, the question has been repeated for 3 times. So I think we are done with that question there. Let's move and basically do another question. Let's move and do another question. Can we go to this sitting here? There is a small question here. I think, is it December 2021? December 2021. December 2021, let me see. Yes, so let's go to December 2021. I hope I have that paper. Do we have it? Do I have that paper? Do I have that paper? Yes, almost at the end of this handout. That's why we have the paper for December 2021. Huko mwisho kabisa. Almost at the end. That's why you get the paper for December 2021. Almost at the end of these handouts, those particular past papers, December 2021, and specifically, there is a question I want us to do here, not the entire question, but part of it, December 2021. And there are 2 papers for December 2021. There is a pilot paper. That is not the paper we're interested with, but we're interested with this paper for December 2021, not the pilot paper. Ukiona imeandikwa pilot paper, check for the other paper. For December 2021, there are 2 papers. And if you are there, just say so that we finish with this. We finish with this because there is another very important question I want us to do. A very important question. Are you there? Are you there? Yes, the question for Bawabu. The question for Bawabu. The question for Bawabu. The question for Bawabu. If you are there, please confirm. Please confirm. Please confirm. Okay, so I presume you are there. You have the question. So I want us to go to question 5. We are not doing the entire question. We are not doing the entire question number 5, but I want us specifically to look on question number 5. I want us to look on note number 3. Note number 3 of that question. You can see the wrong question, but we are not doing the entire question. So actually, that is what we are doing next. That question is that from the topic of published financial statement. That is our next topic. Our next what? Topic. So what are we told in this note number 3? Additional information number 3. We are told that Babu Limited estimated an income tax provision of 113.8 million is required for the year which ended 30th of March 2021. And then you're told the balance on the current tax in the balance represent under stroke over provision of tax liability for the year which ended 31st of March 2022. So then you're told at 31st of March 2021, the tax base of Babu Limited net asset was 292 million less than the carrying amount. The income tax rate applicable to this company is 30%. Now, as far as that note is concerned, note number 3, we basically need to compute two items. Number 1, we need to compute the current tax, which will be charged in the income statement. I hope you can see in part A of that question, we are required to compute, the candidates were required to prepare the statement of profit or loss. We are going to compute the current tax to be charged there. And number 2, we also compute what? We also compute the deferred tax. Now, if you can be able to recall in our previous session, what we said is that as an accountant, anytime you're preparing the income statement or the financial statement, you can't be able to tell the actual amount of tax to be paid. You just estimate. You do what? You estimate the tax to be paid, and you make what? You make a provision. So once you have made a provision, so we say that this one can give rise to over provision, or basically this one can result to something called what? Under provision. Remember, in this case, we said over provision, this one arises whereby the provision which you created as an accountant is basically more than the actual tax. So that gives rise to over provision, of which we say that this over provision in the trial balance, it will be having a credit balance. On the other hand, we said at a provision analysis whereby the provision which you created as an accountant is less than the actual tax. So this gives rise to other provision, of which we say that this other provision in the trial balance will be having a debit balance. We say that whether it is an over or basically other provision of tax, which arises in a certain financial year, assuming in the year 2024 there was over or basically other provision, we say that this other or over provision will be taken to the year 2025, and actually we say over provision will be deducted from the estimated tax liability for 2025. If it is under provision, still it will be taken to the year 2025. It will be added to the estimated tax liability for what? For the year 2025. So what we need to do therefore, as per the information we have in note number 3, is basically to compute the amount of current tax, the amount of the deferred tax, simply because remember what we said in our previous class. We said the amount of income tax, which is basically charged in the income statement, the amount of income tax which is charged in the income statement, this comprises of two components of tax. We have the current what? The current tax. And number 2, we have what? We have the deferred what? The deferred tax. And therefore, that is something you need to note very well, because at this level now, you will not be talking of the corporation tax. If you can be able to recall, for example, in financial accounting, you used to be given corporation tax. You are deducting that directly from the profit before tax. At this level, you'll be dealing with two components of taxes, the current tax and the deferred what? The deferred tax. Yes. So which for the deferred tax, this one can be a deferred tax expense, like what you have computed from the deferred account, which you have prepared here. It can be a deferred tax expense. It can be a deferred tax what? Income. So what I want us to start by computing here, from what we have in note number 3, is the current tax to be charged in the statement of profit or loss for the current year. If you go to the requirement, the current year ended 31st of March 2021. So that is when the current year ended. So how do we compute this particular amount of current tax? This amount of current tax, we are going to compute that using the information which we have in note number 3, specifically paragraph 1. In paragraph 1, you're told Babu Limited estimated that the income tax provision of 113.8 million is required for the year which ended 31st of March 2021. So basically what you're told is that during the current year, the company estimated the income tax to be 113.8 million. So therefore what you're given here And if you go back to the trial balance of that question, in the trial balance of that question, you'll be able to see that the figures are given say in thousands of shillings in the trial balance. So for us to be able to compute this amount of current tax, what we do, we take the estimated tax liability. Estimated tax liability for the current year. That is the year which ended 31st of March 2021. So this is the estimated tax liability. As an accountant, you estimated that during the current year, our company will pay, or this company will pay a tax equal to 113.8 million. But remember what you have said. You need to check whether in the previous year, like in this case, in the year 2020, was there over or under provision? If there was over or under provision, you have to bring it to this year and basically you adjust it to this amount. The net amount which you get is what you charge in the income statement as what? As the current tax. Now, in paragraph 2, we are told, let's go to paragraph 2. We are told the balance on the current tax in the trial balance represent under or over provision of tax liability for the year 2020. So if you go back to the trial balance, can you go back to the trial balance? To the trial balance. In the trial balance, there is an item we are given share of current tax. I don't know whether you can see that item. That item down there almost at the bottom of the trial balance. So we have current tax, basically an amount which appears on the credit side, an amount of 12,800. 12,800. So this is the current tax, and this one appears on the credit side of the trial balance. Remember what you're told in note number 3. Remember what you're told in note number 3, sentence paragraph 2. The balance on current tax in the trial balance, this one, represent under stroke over provision of tax liability in the year 2020. So this is an over or under provision of current tax in the previous year 2020. This is the year 2021. Now we said the examiner specifically will not tell you whether this one was over or under. So what you have to recall is this. An over provision in the trial balance will have a credit balance, and under provision of current tax from the previous year in the trial balance will have a debit balance. And automatically, because this one is on the credit side, this one is what? This one is what? Is what? Over provision. This one is what? Over provision. So being over provision, what do we need to do with that over provision? Do we need to add it here? Do we need to less it here? Being an over provision, we less, we add. We less, we add. Who can tell us? Over provision of current tax from the previous year. Yes, over provision, we said we do what? We less. So what we do here, we less over provision of current tax for the year which ended 31st of March 2020. The over provision is basically 12,800. 12,800. We less it there. And basically we have 101. So this is now the amount of current tax to be charged in the income board. This is the amount of current tax to be charged in the income statement for 2021. Sasa, yes. So when, for example, actually we are going to do that question in our next topic. So when preparing the income statement, once you get the profit before tax, one of the items you raise from that profit before tax is the current tax. Now let's go back to note number 3, specifically the last paragraph. The last paragraph you're told is at the end of the year, that is at 31st March of 2021, the tax base of Babu Limited net asset was 292 million less than the carrying amount. So the income tax rate applicable to this company is what? Is 30%. So what you're told in that last paragraph there is that the carrying amount, actually not the carrying amount, rather the tax base. We are told the tax base of Babu Limited net asset was 292 million less. This one was less than carrying amount with an amount of 292 million. Remember, all our figures are in thousands of shillings. We must be consistent. 292. Now, who can tell us what is this? This particular amount here. 292. What is it? What is that particular amount? Which name will be given to that amount? 292 million. Which name will be given to that? Which name will be given to that value there? Which name will be given to that value? Which name will be given to that value? Yes, that is temporary difference, because you can see it is the difference between carrying amount and tax base. Sasa, yes. So what we need to do here is basically to determine whether this particular amount, is it taxable, is it deductible temporary difference. Now remember what we said. We say that if the carrying amount, and that is something also we have done in the other question, if the carrying amount exceeds the tax base, is greater than tax base, then we have taxable temporary difference. If the carrying amount is less than tax base, we have deductible temporary difference. In which case, this one we have to compute the deferred tax liability. Here we compute the deferred tax what asset. So therefore, for us to determine whether this is taxable or deductible, can we interchange this? We start with the carrying amount. So we start with the carrying amount. Automatically, we're going to change this inequality sign from less than to greater than to greater than. So we'll say carrying amount is greater than tax base. Than tax base with an amount of 292. So if that is the case, then it basically means that this one will be a taxable temporary difference. It will be a taxable temporary difference. So if it is a taxable temporary difference, what do we compute? We compute the deferred tax liability. And actually, whatever you're computing here, the deferred tax liability, just like the other question, this will be the deferred tax liability at the end of the year. So the deferred tax liability on the 31st of March 2021 will be equal to the taxable temporary difference times what? Times the tax rate. So the taxable temporary difference, this one, 292,000. And then in the same point number 3, we have the tax rate, which is basically 30%. 30%. So this will give us a deferred tax liability of what? This will give us a deferred tax liability of what? 292. So this will give us a deferred tax liability of what? Of 87,600. 87,600, is that what you're getting? 87,600. 87,600. 87,600, is that what you're getting? Yes or no? Yes or no? We try to hurry up because of time. So that is just multiplication. That is just multiplying. Yes. So now this deferred tax liability being the deferred tax liability at the end of the year, this one we take it to the statement of financial position, and actually we recognize this as a non-current liability. We take that to the statement of financial position as a non-current what? Liability. But it's also important for us to determine the amount of deferred tax to be charged in the income statement. How do we determine the amount of deferred tax to be charged in the income statement? So to do that, we must prepare something called a deferred tax account. We must prepare something called a deferred tax account. Although in this case, this one is quite simple because we are preparing this one for just 1 year. For just 1 year. Now, in preparation of this account, what do we record here? Now, first of all, if we go back to the trial balance, can we go back to the trial balance which you're given? To the trial balance. In the trial balance, in our trial balance, there is an item which you're given in the trial balance, which is called the deferred tax. Actually, deferred tax is above the current tax. I don't know whether you can see it. Is the above current tax. So we have a deferred tax of how much? 97,600. 97,600. And I hope you can see that deferred tax. That deferred tax of 97,600 is just referred to as a deferred tax. And in this case, it is on the credit side of the trial balance. So now take into account it is on the credit side. Is this a deferred tax asset or is it a deferred tax liability? Because it can either be a deferred tax asset or it can be a deferred tax liability. Will this be a deferred tax asset? Will it be a deferred tax liability? Deferred tax asset or a deferred tax liability? Deferred tax asset or deferred tax liability? This particular amount, which is on the credit side, that one is very simple. Remember the acronym, our acronym DIRA. So in this case, if you're given an item on the credit side, it's very simple. It's for you to know that is a liability. There is no way an asset can be on the credit side of the trial balance. So being a deferred tax liability, that is what we start by recording here, because that is the deferred tax at the start. This is the deferred tax at the end. So we know all liabilities. When preparing a ledger account, all liabilities, they have a credit balance. So we start by recording the balance brought down, which is the opening balance, which is 97,600. So that is the balance at the start. Then at the end of the year, what do we have? At the end of the year, we have this one, deferred tax liability. I've said a deferred tax liability should be recorded in this account, just like what you have done in the other question on the credit side. But if it was a deferred tax asset, we recorded the balance carried down here. So the balance carried down, which is the deferred tax liability, is 87,600. Then what we do? We balance our account. We have said the balancing figure is what we take to the income statement. And I hope the balancing figure in this case will be on this side. So this will give us 97,600. 97,600. What is the difference? 10,000? Yes, 10,000. 10,000. So this balancing figure, which is on this side, the record we have seen, this one is called a deferred. A deferred tax what? This one is called a deferred tax income. That one is called a deferred tax what? Income. That one is called a deferred tax income. That is basically the amount which we take to the income statement. So this is basically a deferred tax what? Income. A deferred tax what? Income of 10 what? Of 10,000. So that is what we take to the income what? To the income statement. So basically that is what was required as far as that note is concerned. Although I've said we will do that question in the process of in our next topic. In our next topic, you're going to do that particular question. So what I want us to do, I want us to take a short break. There is another question which I want us to do here. Which I want us to do here after the short break. This is a question. These papers are mixed up. They are totally mixed up. It was a question from the sitting of around 2021, 2022. My papers here are totally mixed up. Yes, so the question I want us to do after the break is April 2022. April 2022 question 5B. Actually, I think it's like almost all of these questions for deferred tax is like they are in question number 5. April 2022, question 5, and because that question will consume some time, so I think we'll just take a short break, and then we come back because I want us to finish the question on time. April 2022, question number 5B. 5B. So let's just take a short break of 5 minutes, 5 minutes only, and then we come back. Make sure you have this question with you. So we come back at 9:22. The question here. I want us to do this question here, and we will try and move at a speed. Because of time, I want us to finish the question. So we are told Zion Limited. I hope you have the question. April 2022. Zion Limited, a public limited entity, is in the process of finalizing its financial statement for the year which ended 31st of October 2021. So we are told the following information has been extracted from its accounting record for the purpose of estimating the deferred tax balances. So we will not go through this. We will go through it as we answer our question. So we have note number 1, note number 2, note number 3, note number 4, note number 5, note number 6, 7. So what are we required to do here? We are required to compute the relevant temporary differences. And number 2, we are required to prepare the deferred tax account. I want us to start with the Roman 1, basically whereby we are required to compute what? The relevant. In other terms, you're required to compute the temporary what? The temporary differences. We're required to compute the temporary differences, the TD. So what is just important here for us to remember is how do we compute the temporary difference? How do we compute the temporary difference? So in this case, we know to compute the temporary difference, to compute the TD. So we just take the carrying amount minus the tax base. Minus what? The tax base. So what we just need to do is to go through the information which are given in this particular question. from actually note number 1 all the way to note number 5, we are given various items of assets and liabilities. So what we need to do here is just to identify the year carrying amount, to identify the year tax base, and then we get the temporary difference. So in this case, we have to come up with a table here. In our table, we will have a column for the assets or liabilities we are given from note 1 up to note number 6. The next column here will be for the carrying amount, The next column will be for the tax base. And the last column here will be for the TD, the temporary difference. Then if you take the values which are given, I think in note 1, 3, 2, 3, the values they are given in million of shillings. So we will indicate up there that all our values will be in million of what? In million of shillings. We need to indicate up there that our values will be in million of shillings there. Yes, so we just need to go through that information. I'll basically be able to guide you, to give you a number of notes here, a number of notes in terms of how to determine the carrying amount, how to determine the tax base of the various items of asset and liabilities. Because in this case, automatically you're not given those carrying amount, you're not given those particular what tax base. Let's go to note number 1. In note number 1, you're told inventory is stated in the financial statement at the roll of cost, the net realizable value. The company wrote down its inventory by 120 million to a net realizable value of 1130 million. The reduction in value is ignored for tax purpose until the inventory is sold. So what you're given here, you first of all write that whatever you're given in note number 1 is what? Is inventory. Then this note I'll give you here are very, very important. I'll give you some notes which will help you to know how to determine carrying amount and tax base. We start with inventory. Now, number 1, if you can be able to recall from what you did in financial accounting, though there is a small topic we're going to do in relation to this in a FR&A, inventory should be valued in accordance with the International Accounting Standard number 2. Whenever you're determining the value of inventory in financial accounting, you do that in accordance with the International Accounting Standard number 2. And actually, this particular standard requires that the inventory or the value for the inventory should be the lower of the two. Actually, should be the lower of two values, the cost or number 2, the net realizable value. So meaning that this being the value for the inventory, this is the value at which the inventory is recorded in the statement of financial position. Remember, the inventory here we are referring to the closing inventory. Closing inventory, is a current asset. Being a current asset, it go to the statement of financial position as a current asset. So we record the inventory in the statement of financial position at the lower of the 2. And being the lower of, this being the value at which the inventory is recorded in the statement of financial position, this one is the carrying amount. In other terms, we say that the carrying amount of inventory is basically the lower of the 2. The lower of the 2. What about tax base? What about the tax base of the inventory? A tax base of inventory is basically equal to the cost. That is what you just need to know. Anytime you come across this item of inventory, you just need to know cost. The tax base is equal to the cost, and basically the carrying amount is equal to the lower of the two values. Now, let's go back to the information which is given in note 1. We are told the inventory is stated in the statement of financial position at the lower of the two values. And then you're told in sentence 2, the company wrote down its inventory by 120 million to a net realizable value. So in that case, we are given the net realizable value, which is 1113 million. But basically, we are told that in arriving at this value, the value for the inventory was written down. The value for the inventory was written down. In other terms, in arriving at this value, the value for the inventory was reduced with 120 million. So what that means is that we are going to use that information to get what? The cost. How do we get the cost? To get the cost, we will take this 1130 million, and basically we add back 120, because in arriving at 1130, the value for inventory was reduced with 120 million. It was written down. It was reduced with 120. So we get what? What do we get here? We try to hurry up because of time. I want us to finish this question here. This one will give us, what are you getting here? This one will give us what? Will give us 1250 million. 1250 million. So having that, then we just need to move and basically use this particular concept which I've explained there to determine these two values. Carrying amount, we have said should be the lower of these two values. Cost is 1250 million. Net realizable value is 1130. We take the value which is lower. The value which is lower is 1130. The tax base is equal to the cost. The cost is what? 1250. So 1250. So then we get the difference. We take this minus that, and basically we will get a difference of 120. And this one is a negative. Once you take this minus that, you get negative 120. So being negative, that one is deductible. Temporary difference. Make sure you indicate whether that temporary difference is taxable or deductible. If you get a negative figure, it's deductible. So we are done with that. Let's move to point number 2. So what is important is this. These notes I'm giving, make sure you are noting them somewhere. So let's move to note 2. Note 2, we are given the trade receivables. Even before we go through that information, there is also a note I will give here that for trade receivables, and this one also applies to the trade payables. So the carrying amount, this one is equal to the net amount. So for example, we know from financial accounting, whenever you're recording receivables in the statement of financial position, you take receivables and then maybe you less things like the allowance or the provision for doubtful debt. So the amount which you get is the net amount. So the carrying amount is the net. What about the tax base? Tax base is the gross amount. It is the original amount. It is the original amount of receivables before making any adjustment. Before making any what? Adjustment. Let's go through that point now. Having that knowledge. So we are told that trade receivables had a carrying amount. In our case, we already have the carrying amount. And this carrying amount, automatically, this one has to be the net. So there are a number of adjustments which are made in arriving at that what? Value. So we are told had a carrying amount of 450 after making a provision for a general provision for doubtful debts of 30. So in arriving at this value of 450, there's an amount of 30 million which was deducted. And yes, and actually we are told that this provision is not allowed for tax purpose. I think this one is quite simple. So we have the net amount which is 450. How do we get the gross? Who can tell us how do we get the gross? And we try to hurry up because of time. Betty, how do we get the gross? Vincent, Jacqueline, Jen. Tumepewa, we have what? We have the what? We have the net amount. The net amount is 450. Basically, we know that in arriving at that 450, there is an amount of how much? There is an amount of 30 which has been deducted. How do we get the original value? We add back. So basically, that will give us what? That one will give us 480. And this we get the difference, which is basically 30, which is negative, and that is still deductible, temporary difference. So what is important? This. So, and I've said that also applies to payables. So then note number 3, we are given note number 3 here. We are given something called PPE. I'll also give a note for that. PPE, the carrying amount, this one is equal to the net book value or the revalued amount based on what you are given. The net book value or the revalued amount, whereas the tax base, this one is equal to something called the written down value. Remember the other question which we did, the question we started with there, we said in case you're given an item of asset, carrying amount is the net book value, and then tax base is the written down value. Remember the first question we did. So we are given property, plant, and equipment. And moving forward equally, you need to get used to some of these terms because in the lower level, you are not using these terms. PPE, these include all tangible non-current assets. All tangible non-current assets are included here. Motor vehicles, land and buildings, furniture and fittings, all of them, we refer to them as property, plant, and equipment. So we are told the property, plant, and equipment had a carrying amount. We have the carrying amount, 3050, and the tax base. In fact, this one is quite simple, over 2750. And then you're told during the year, I'll be able to explain the last point. We are not going to use it here, but I'll be able to explain that last point first of all, we put an X to that because we are going to use it in answering Roman 2. So first of all, we will keep that last paragraph, but I'll be able to explain how we are going to use that gain, that revaluation gain. So, but in our case, what we need is these two values, 3050 minus 2750. And basically that will give us 300, which is positive, and this is taxable temporary difference. Is taxable temporary difference. Okay, so we move to point number 4. Point number 4, we are told during the year which ended 31st of October 2021, development expenditure amounted to 480 million, was capitalized, and we are told amortization of 20 million was charged for the profit or loss, to the profit or loss. This development expenditure was allowed for tax purpose in full during the year. Now, let's also, let me give a note for that. Basically, generally, we refer to this as intangible assets. Intangible asset. So intangible asset, basically, these are the costs which are incurred by the company, cost incurred and capitalized. These are costs incurred and capitalized. You need to understand what you mean by that. So when we talk about costs which are incurred and capitalized, these are the costs which the company will incur. For example, whenever the company is developing a new product, now those costs, are they taken to the income statement and deducted from the total incomes? No. So what will happen is that once those costs have been incurred, they are capitalized. Being capitalized means that those particular expenses or costs will be accounted for as assets. In fact, they are referred to as intangible assets. They are referred to as what? Intangible assets. And I give good examples of these costs which are incurred and capitalized. One is development expenditure. Development expenditure is an expenditure incurred in coming up in developing a new product. We know that if the company is developing a new product, there's huge costs which are incurred. The company may be required to buy some machines. The company may need to do some market research. Will this product be acceptable by customers? The company need to invest in marketing. There is huge cost incurred by the company developing a new product. That cost should be capitalized. And actually that is done in accordance with IS 38. Another good example is like these telecommunication companies, Akina Safaricom, Akina Airtel. Usually they are required by communication authority for them to be allowed to operate in Kenya. They must pay a license of like the next 5 years. So you may hear a company like Safaricom being required to pay to the government like a license of 5 billion. 5 billion to operate in Kenya for the next 5 years. It is obvious that once that amount has been paid, that license has been paid, which will enable the company to operate in Kenya for the next 5 years. That company cannot treat that as an expense in the income statement. So what happens is that cost is capitalized. It is treated as an intangible asset, and then it will be amortized. To amortize is to gradually write off. It will be amortized in the next 5 years. So any intangible asset which arises from capitalization of an expenditure, how do we determine its carrying amount? How do we determine its carrying amount? How do we determine the tax base? Now, carrying amount, this one is equal to the cost. This one is quite simple, minus amortization. Minus what? Amortization. This one is quite simple, for example, from the information which you're given there. And then this one, tax base, this one is equal to amount, allowable for tax purpose, in the future. In what? In the future. So when we talk about amount allowable for tax purpose in the future, we are referring to the amount which will be treated by the company's allowable expense in the future. How much amount will be deducted from the total incomes of this company in the future when the company is computing the taxable profit? In most of the questions you'll come across, the examiner will tell you that when this cost was incurred, for example, you can be told the cost was incurred during the current year, the full amount was treated as allowable expense. So if the full amount was treated as allowable expense, either during the current year or in the past, it automatically means that the amount which will be allowable for tax purpose in the future automatically will be zero. Now, what you need to note is that if you have a business and maybe you have incurred an expense of 20 million during the current year, the year 2026, and you treat this as allowable expense. By treating it as allowable expense, you have deducted that from your total incomes in determining the amount of tax you are going to pay to the government. Now, it is obvious that in the future, there is no way the taxman, the Kenya Revenue Authority, will allow you to deduct this from your future incomes. to treat this as allowable expense again in the future, because by doing that, you'll be reducing the taxes you're paying to the government. So if you're told the amount has already been treated as allowable expense during the current year or actually in the past, then the tax base here is always equal to 0. The tax base is always equal to 0. The amount which will be allowable for tax purposes in the future will be 0. So let's go through this point to see what you're told. So we are told during the year, that is the current year, the development expenditure amounted to 40 million and was capitalized amortization of 20. So that one is quite simple because that will help us in computing the carrying amount. We take the cost minus amortization. So for 8 minus 20, and basically that one will give us what? Will give us for 60. Remember, you can refer to that as development expenditure, or you can just refer to it as intangible asset, no problem. So this one will be for 60, 480 minus 20. Then in the other sentence, we are told this development expenditure was allowed for tax purpose in full. That is very important, in full during the current year. The amount was treated as allowable expense during the current year. Then we need to ask ourselves, how much amount will be treated as allowable expense in the future? Based on what I've explained here, how much amount will be treated as allowable expense in the future? Who can tell us? The amount will be treated as allowable expense in the future. The amount was treated as allowable expense during the current year. I see whether you have understood what Morimo has explained there. The company incurred a development expenditure of 480 million during the current year. The full amount was treated as allowable expense during the current year. Will the taxman allow this company to treat that expense again in the future as allowable expense? Automatically, you have said no. If you have incurred an expenditure of 20 million, you have treated that as allowable expense during the current year. It is obvious that you can't go back and you tell the taxman, I want you to keep on treating this as allowable expense. He will not allow that because you want to reduce the taxes you are paying to what? To the tax authority. So therefore, in this case, because it was allowed for tax purpose in full during the current year, the tax base is 0. The tax base is what? 0. So we get the difference, which is 460, and that is taxable temporary difference. So what is important? This point here. Very, very important. So let's move to the last point. We are told that trade and other payables. Now, trade and other payables, I've said the concept is the same with that of receivables. We have the trade and other what? And other payables. And basically, in this case, you're told the trade and other payables are carried at 600. Carried at 600 million. That is the carrying amount. Carried, they are recorded in the statement of financial position at 600. So we are told included in the other payables, remember these trade and other payables, are accrued expenses of 100 million. So there is an amount which is included here, which are accrued expenses, whose related expenditures are deductible for tax purpose on cash paid basis. What does that mean? So included in this particular amount of 600, we are told is an amount of 100, and you are told this one will be treated as allowable expense. This one will be treated as allowable expense on the cash paid basis. On the cash paid what basis? What that means is that this 100 million, which is included here, will only be treated as allowable expense once it has been paid. That's what you mean by cash paid basis. It will only be treated as allowable expense once it has been paid. Once it has been what? It has been paid. Let me ask, this particular amount of 100, which is included within payables, what you just need to know here is what are payables. Payables is what the company is to pay in the next 1 year. Automatically, this amount of 100 million, which is included here, this amount has not been paid. That's why it is part of the payables. And because it is not yet paid, then during the current year, automatically, it was not treated as allowable expense because we are told that 100 will only be treated as allowable expense once it has been paid. Once it has been what? Paid. It has been paid. So it has not yet been paid. So therefore, how do we determine the tax base? To determine the tax base, the amount which was considered for tax purpose here, we will take this one, we exclude this one 100, because this one will only be considered for tax once it has been paid. Has it been paid? Not yet. So we exclude it. So this one will give us what? This one will give us 500. This one will give us what? 500. That is the carrying amount. Now, in this case here, it is also important for you to note, for example, the first item here we had was an asset. This one was an asset. This one was an asset. Development expenditure, which I've said is a form of an intangible asset. This one is still an asset, but this one is a liability. Now, what is important here is for you to note anytime you come across an item of a liability here, because this one is a liability, you record both figures as negatives. Both figures you record them as what? As negatives. Because by the end of the day, we will take these temporary differences, we add them. So we should take those of assets and those of liabilities like being negatives. Yes. So if you come across an item for liability, make sure you record both figures as negatives. So how do we work out this one? We will take negative 600. This one, we minus this. This is negative 500. Sasa, yes, I've taken negative 600 minus negative 500. So then I have negative 600 minus, and a minus is a plus 500. So this will give us negative 100, which is deductible temporary difference. Deductible temporary difference. And I think we are done, because if we go to what we have, note number 6, we are given the deferred tax liability. We are going to use in Roman 2. And then number 7, we have the tax rate. So having computed this, basically what was the marked here are these temporary differences. These are the values which were marked here. Those are the values which were marked. But now, for us to be able to answer what is given in part, what is required in Roman 2, we must get the net amount of the temporary difference. We need to add all this, because you can see we have various temporary differences. We need to get the net amount of temporary difference, a single figure of temporary difference, which will either be taxable or deductible. Let's work out this. Whatever is a negative, you take it as a negative. Whatever is a positive, you take it as a negative. We have negative 120 minus 30 plus 300 plus 460 minus 100. And basically in this case, I'm getting 510, which is a positive. Being a positive, that one would be known as the net taxable temporary difference. The net taxable temporary difference. The net taxable temporary difference. Net taxable temporary difference. So that basically what was required. You see these points which I've given you here? Avoid Jack Jane. You see these points which I've given you there? Those points are very, very important. And this is also a topic you'll do in AFR. In advanced level, this is also a topic you'll repeat. If you can be able to remember this concept which I've given you here, it will also assist you once you go to advanced financial reporting, because you'll also come across these questions in AFR, similar questions. So if you can be able to recall this particular concept which I've given you here, they will help you out. Now, let's move to the last part of the question. You should be able to do it within 5 minutes. So in Roman 2, we are required to prepare the deferred tax account. Now, in preparing this deferred tax account, the first item you need to record is basically what you're given in note number 6, because in note number 6 you're told the deferred tax liability on 1st November 2020, which is basically the start of the year, was 292 million. Remember, all our values here are in thousands of shillings. All our values here are in thousands of what? Of shillings. So at the start of the year, per note number 6, there was a deferred tax liability, just like the other question which you have done for December 2021. Taking into account there was a deferred tax liability at the start. That will be the opening balance in this account, and specifically on the credit side. I've said all liabilities, they have a credit balance. So how much is the deferred tax liability? The deferred tax liability is basically 292 million, but our figures are in thousands of shillings. Then, at the end of this year, recall from what you have done in Roman 1, our company had a net taxable temporary difference. So remember, we have said that we use this taxable temporary difference to compute something called a deferred tax liability. So the deferred tax liability will be equal to the net taxable temporary difference. We multiply that with the tax rate. So our deferred tax liability at the end of the year will be this one. Sorry, and our figures, we are recording them here is in million of shillings. Sorry for that. So equally here, our figures should be in million of shillings, not in thousand of shillings. in million. So this one would be 292. Yes. So therefore, the deferred tax liability at the end of the year will be equal to 510, which is this one. We multiply that with the tax rate, which is in note number 7, 30%. 30%. That will give us what? 510 times 30%. That will give us 153 what? Million. So that being a deferred tax liability at the end of the year, we have said that the balancing figure, that one should be recorded here. And that is how much? That is 153. 153. There is something small I want to explain here. Can we go back to note number 3? Note number 3, specifically the last sentence. The last sentence of note number 3. There was a revaluation gain on property front end equipment. There is a question we did for cash flow. The question which was there last sitting. And there is some information. I don't know whether you can be able to recall that. We were told in that question the company revalued some land buildings, but you were also told that the company does not account for deferred tax on revaluation deed. And I think I said I'll be able to explain that once we come to this topic. Now, anytime the company revalues an item of PPE, revalue an item of PPE, that basically affects the carrying amount. Because whenever you're computing this tax base, we compute the tax base using what? Using the cost, although that is not important. In fact, let me not go into details. Now, anytime you're told a company revalued PPE, there was a revaluation gain because you're told PPE were revalued and they were revalued upward. Automatically, that is a gain. So anytime and there was a revaluation of PPE and there was a revaluation gain, so we compute something called the deferred tax expense. The deferred tax expense on the revaluation gain. Just understand this. So deferred tax on revaluation gain. How do we compute this? We take the revaluation gain, we multiply that with the tax rate. We multiply that with what? With the tax rate. So in our case, as per note number 3, the last sentence, the revaluation gain, this one, is 150 million. The tax rate is 30%, which will give us what? Which will give us 45 what? Million. I hope you're getting that. 45 million. 45 million. Now, how do we account for this deferred tax? Deferred tax on revaluation gain. How do we account for this deferred tax? So this deferred tax on the revaluation gain is debited in the account called the revaluation reserve. Remember, we said if, for example, some items of PP have been revalued upward with 150, this revaluation gain is taken to an account called revaluation reserve. Revaluation reserve is a component of equity. Now, this deferred tax on revaluation gain, we are saying we debit it in that account. In other terms, to debit is that this, when transferring this amount to the revaluation reserve account, we will take 150, we less 45. To debit the revaluation reserve is to less. So and then we credit an account called the deferred tax account. The deferred tax what? Account. That is basically how we account for this deferred tax expense on revaluation gain. Compute, or actually compute that amount by taking the revaluation gain times tax rate, and then you debit the revaluation reserve, credit deferred tax. So what we are interested with in our case here is the entry in this account. The entry in this account is that this account should be credited. So naturally, we can refer to that as the deferred tax on the revaluation gain. And I think we have already computed that here as an amount of 45. Then we have said that the next thing we do is to balance this account. The balancing figure, if it is on this side, it is taken to the income statement. And this one is known as a deferred tax expense. If the balancing figure is on this side, is taken to the income statement, is known as deferred tax income. Is known as deferred tax income. Yes, so you can see from what you have done in the other question, in this case now we have an additional item which you're introducing here, this deferred tax. Deferred tax on revaluation gain. Yes. So I think in our case we will have a balancing figure on this side. We have 272 plus 45 plus 45, which will give us 317. 317. So the balancing figure, which take 1 minus, yes, and basically that one will give us what? That one will give us 164. So this is basically what is required in Roman 2 of that question. Roman 2 of that question, and the marks allocated there were 4. So automatically what is marked here is this, that, and that. So the marks given here were 4 marks. So these are very, very good question, a very, very good question on deferred tax. A very, very good question on deferred what? Tax. And basically what I've said is that even in AFR, you'll also come across these particular what? Questions. But what I've said is that those points which I've given you there, those notes, those NBs, that is basically what will help you even the moment you move to the upper level. So basically that is it. And that now brings us to the end of that topic.